Most people buying these stocks have no idea what they are actually holding. These are not fringe penny stocks. You will recognize every single name. Weeks of research, earnings reports, and analyst data went into this list. These are 10 companies ranked from risky to ruinous. In these cases, meme hype, crushing debt, and outright fraud destroyed billions in shareholder value. We start at number 10 with a stock that became a cultural phenomenon. In 10th place, AMC Entertainment stands as a cautionary tale of meme stock mania colliding with harsh financial reality. Social media campaigns painted AMC as a ticket to easy riches, but the numbers tell a different story. Shares outstanding exploded from around 100 million to over 350 million after a string of secondary offerings and the controversial AP preferred share issuance. This massive dilution gutted per share value, leaving retail investors holding a shrinking slice of the pie. Box office revenue still lags behind pre-pandemic levels, and short interest remains elevated, fueling wild price swings but offering little hope for a true turnaround. Hype may generate headlines, but it cannot reverse the damage of relentless dilution and declining fundamentals. If a company cannot clearly explain when it will be profitable, steer clear. No amount of online enthusiasm can change the math. Number 9. Peloton Interactive soared to a nearly $50 billion valuation during the pandemic when at-home fitness demand seemed unstoppable. But that surge masked a business built on fleeting trends and unsustainable losses. In a single fiscal year, Peloton lost over $2 billion, burning through cash as demand evaporated and supply chain costs piled up. The company cycled through multiple chief executive officers in just a few years, a sign of deep instability at the top. Subscriber growth stalled, and attempts to pivot beyond bikes failed to offset mounting red ink. As the world reopened, Peloton's core market shrank, leaving shareholders exposed to a collapsing narrative. Hype can drive headlines, but when the story fades and losses keep mounting, the stock price follows. If a company cannot clearly lay out when it will turn a profit, it is not a business you want to own. In 8th place, Lucid Group promised to revolutionize electric vehicles, but the numbers reveal a different story. Despite grand projections in its SPAC prospectus, Lucid has delivered fewer than 10,000 cars, falling far short of its own manufacturing targets. The company's annual cash burn now exceeds $3 billion, a staggering figure for any automaker, let alone one with such limited output. To keep the lights on, Lucid has repeatedly turned to secondary offerings, each one diluting existing shareholders and eroding per-share value. The gap between capital raised and vehicles actually delivered keeps widening, while the company's own filings warn of a cash runway measured in months, not years. When a business burns billions but can't show operational traction, retail investors are left holding the bag. If a company can't explain when it will turn a profit, it's not a stock worth owning. Number 7. Virgin Galactic dazzled retail investors with visions of commercial space travel, but the numbers tell a sobering story. After more than 2 decades and countless headlines, the company has managed only a handful of suborbital flights. Each ticket costs $450,000, instantly shrinking the pool of potential customers to a tiny global elite. Revenue remains minuscule, and the promise of a booming space tourism industry has yet to materialize. FAA notices have repeatedly grounded the fleet over safety concerns, forcing long pauses in operations and erasing any hope of predictable cash flow. To stay listed on the stock exchange, Virgin Galactic executed a reverse stock split, a classic sign of a company struggling to maintain investor confidence. The business model depends on a market so narrow and so delayed by regulatory hurdles that even the most optimistic projections seem out of reach. When a company's entire future hangs on selling a luxury product to a microscopic customer base, no amount of hype can overcome the math. If a company can't lay out a clear path to profitability, it's not a stock you should own. Number 6. Tilray Brands rode the wave of cannabis legalization, selling investors a vision of explosive growth. But beneath the headlines, Tilray's financials paint a far bleaker picture. The stock has collapsed more than 95% from its peak, erasing nearly all shareholder value. Every single year since going public, Tilray has posted operating losses, burning through cash while promising a future that never quite arrives. In 2024, the company pivoted into beer and spirits, acquiring craft beverage brands in a bid for profitability. Yet this move pits Tilray against global giants with deeper pockets and stronger distribution, while the core cannabis division still struggles with razor-thin margins and persistent oversupply. Even as revenue topped $1 billion, the cash cash burn continued over $200 million in a single year, forcing another massive secondary offering that diluted existing shareholders. When a company relies on regulatory optimism but cannot produce sustainable profits, retail investors are left holding the bag. If a business cannot clearly explain when it will be profitable, it is not a stock you should own. Number 5. Carvana's debt-fueled growth story has turned into a cautionary lesson in balance sheet risk. The company now carries over $5 billion in long-term debt, a burden that dwarfs its operating cash flow, and puts the business in a precarious position if the used car market stumbles. In 2024, Carvana posted a net loss of $1.9 billion and burned through $840 million in cash, with no clear path to sustainable profitability until at least 2025. Yet even as financial stress mounted, insiders sold large stakes near the stock's all-time highs. Executives and board members collectively offloaded more than $1 billion worth of shares in the run-up to the downturn. This pattern of heavy leverage, negative cash flow, and insider selling signals a governance gap that ordinary investors can't afford to ignore. When a business survives on borrowed time and borrowed money, the risk of insolvency in a market downturn is not just theoretical. If a company can't explain when and how it will pay down its debt and turn a real profit, it is a stock you should never own. Number 4. Beyond Meat once stood at the center of the plant-based food craze, with bold promises of reshaping what Americans eat. But the reality for investors has been a harsh lesson in how quickly a growth story can unravel when demand dries up. Over the past 3 years, major restaurant partners, once eager to feature Beyond's burgers and sausages, have quietly removed the products from menus, citing weak sales and high costs. Each lost partnership chipped away at the company's distribution footprint, leaving supermarket shelves stocked with unsold inventory. Revenue has now declined year over year, with the 2024 annual report showing a 6% drop and no sign of stabilization. The stock price, once over $200, has collapsed by roughly 97% from its peak, erasing nearly all shareholder value. For a brand so dependent on buzz and shelf space, the loss of key partners triggered a downward spiral that even aggressive cost-cutting could not reverse. If management cannot clearly explain when and how it will return to growth and profitability, it is a stock you should never own. Coming to the top 3, Grab Holding serves as a warning about the dangers lurking behind flashy growth narratives in emerging markets. After a high-profile merger with a special-purpose acquisition company, Grab's share count nearly doubled within 2 years, ballooning from 112 million to over 207 million shares, as the company relied on repeated secondary offerings to fund its operations. That relentless dilution chipped away at per-share value, while the business itself posted an operating loss of more than $1 billion in a single year. Despite bold promises of Southeast Asian dominance, Grab has struggled to turn the corner, and its most recent filings reveal persistent negative cash flow and ongoing dependence on outside capital. But the real risk runs deeper. Grab faces mounting regulatory pressure, including an antitrust investigation by Singapore's Competition Commission over its ride-hailing pricing. In markets where government intervention can change the rules overnight, even the most compelling growth story can unravel fast. When a company burns cash, dilutes shareholders, and operates under a cloud of regulatory scrutiny, the odds are stacked against retail investors if management cannot clearly explain when and how the business will reach sustainable profitability. It is not a stock you should ever own. Number 2. Nikola Corporation stands as a textbook warning about what happens when management credibility collapses. In July 2020, Nikola released a video of its flagship truck supposedly driving under its own power. Investigators later revealed the truth. The vehicle was simply rolling downhill, and the footage had been staged to mislead investors about the company's progress. That single act of deception would unravel everything. The Department of Justice and the Securities and Exchange Commission charged founder Trevor Milton with securities fraud, citing false statements about Nikola's technology, production readiness, and order book. In November 2022, Milton was convicted on multiple counts and sentenced to 2 years in prison and ordered to pay $1 million in restitution. As legal pressure mounted, Nikola's financial position deteriorated, cash burn outpaced revenue, debt piled up, and the company's own risk disclosures began referencing the threat of bankruptcy. By April 2024, Nikola filed for Chapter 11 in the Southern District of New York. The reorganization plan wiped out retail shareholders. Common stock was converted into nearly worthless warrants with a token payout of 2 cents per share. Nikola's story is a stark reminder: when management integrity fails, equity can vaporize overnight. If a company cannot explain its path to real profits and you cannot trust what the CEO says, walk away. No amount of hype can protect you from the consequences of fraud. And finally, in first place, Bed Bath & Beyond stands as the ultimate warning about the dangers of chasing hype over substance. During the meme stock frenzy, the company's stock price soared more than 400% in a matter of days, fueled by viral posts and promises of a short squeeze. But beneath the surface, the business was collapsing. Sales had been falling for years, inventories were piling up, and debt had ballooned past $2 billion. In April 2023, reality caught up with the fantasy. Bed Bath & Beyond filed for Chapter 11 bankruptcy in Delaware federal court, listing billions in liabilities and no viable path to recovery. The reorganization plan approved that October wiped out nearly all common shareholders. Over 1 billion shares were reduced to pennies, leaving retail investors with nothing. The human toll was just as severe. CFO Terry Gates died by suicide only days after the stock's final spike, underscoring the chaos and personal devastation behind the headlines. By the time the brand was sold off to private equity, the once familiar chain was gone, and retail investors were left holding worthless shares. Bed Bath & Beyond's rise and fall isn't just a story about numbers, it's a stark reminder that hype can mask fatal flaws, and that no amount of online enthusiasm can save a business with no future. If a company can't clearly explain when and how it will make real profits, walk away, because when the music stops, the story-driven investor is always left standing alone. Across all 10 stocks, one pattern is undeniable. Hype and hope cannot cover up relentless dilution, runaway debt, and a missing path to profit. If a company can't explain when and how it will make money, you do not own a stock, you own a story. Protect your portfolio accordingly.